Hello everyone and welcome into the channel. My name is Brent and today we're going to be recapping the market performance for March 10th to the 14th, 2025 and discuss some upcoming events that could influence the markets this week for March 17th to the 21st. So if you enjoyed the content, please go down below, subscribe and give this video a big ol' thumbs up. Okie dokie, let's go ahead and get started. Okay, so as far as the market recap goes, last week we ended very positively with the Dow Jones up 1.65, the Nasdaq 2.61, the S&P 500 up 2.13. This is essentially the very best day of 2025, and this kind of goes with the rule. If you go ahead and sell out on the way down, you're like, okay, Wednesday, Thursday, you're like, dang, the market tipped over 10%. I don't want it to fall down to 20%. I'm going to go ahead and sell off my position now. If you sold off on Thursday, you'd miss out on one of those best recovery days. And if you miss out on just 5 or 10 or so recovery days, the best days in the market, your percentage recovery, the percentage total in your overall uh, equity wise capital appreciation gets knocked down from a average of 7 to 10% to an average of 2 to 3%. So it really gets knocked out of whack. Okay, so how are we, what influenced the market on Friday? We had a lot of green out there, right? Tech companies across the board were very positive. The Magnificent Seven, that we've kind of highlighted here in the last few days, just rose up very positively. Tesla and Meta being some of the bigger ones. We'll obviously in a video over there with a whopping 5.27%. But year to date, NVIDIA has actually been doing really well in comparison to some of the other positions. They're only down 9.4, whereas Apple is down 14.75. Microsoft is showing down 7.82, but they have not done well over the last year. Google's down 11.98, Broadcom 15.66, and Amazon 9.77. Tesla, they were down nearly 50% when we did a video last week. Now they're only down 38%, right? So yeah, they're still doing pretty bad in the short term, but we'll see how it goes. Last time, we're taking a look at the Fear and Greed Index. Last time we had taken a look at this last week. The Fear Index was at a 16. Here we are on Sunday, early market hours. It is at a 21 right now. You can see that a year ago we were in the very greedy phase, even up to about 6 months ago we were in that very greedy phase. So that's definitely came down quite a bit as fears have hit the market. Now, looking at after hours, if I wanted to go ahead and just kind of quickly, what happened after hours, right? Friday, we had some huge run ups in the market, but after the market closed, what took place? The Dow Jones made its way down 0.54% in the after hours. S&P 500 went down 0.66% in those after hours, and the Nasdaq went down 0.73% after hours before officially kind of closing for the day. So even though it had gained that massive 1.65, 2.61, 2.13 after hours, it gave up at least a 0.5% to a quarter of a percent or 0.75%. So it really came down after hours. Now, as far as where these are at, every single one of these indexes, I'm using their ETF that is able to be traded for this. It's still trading well below the 200-day moving average, with the S&P trading at 562. Its 200-day moving average right now will probably be acting as resistance because of a lot of the companies such as the Magnificent Seven that are also trading below that 200-day and have a lot of pressure right now to kind of stay down here. They're going to be trying to break above it, retest it. So I don't see the market recovering and just kind of bouncing up all the way breaking above that 200-day moving average. I do feel like we'll have some sort of a bounce here during this week. That's kind of what I'm looking for looking forward. I'm looking for that bounce in the market to make some sort of recovery from around 562, just kind of looking at SPY to around 568, 570 before it retests that recent low and either break below or bounce back up and kind of make its way up. So I'm kind of waiting to see what takes place. This will be a very important week going into the 17th to the 21st to kind of showcase what will exactly, what will happen going forward. The Dow Jones is very trading very low onto the 200-day moving average. It has fallen, I believe, the least. The Dow Jones has not gone into correction territory. We'll go ahead and cover that here in just a minute. And then the Nasdaq has fallen 11% year to date, putting it down in the correction territory here. It is still a bit below the 200-day moving average, so it's very tech heavy with Tesla very much weighing it down. So I do see the Dow Jones potentially, every one of these will more than likely kind of trend sideways with as much as the tech that they have within them outside of the Dow Jones. There's that steel tariff that's going to be affecting them, and we'll talk a little bit about that here moving forward. Okay, so we chatted about some of the indexes, so let's go ahead and cover the main highlights. So I went ahead and highlighted some of the areas I want to cover within the article here. If you guys have anything you'd like to share, please let me know down in the comment section below. I would really love to hear from you guys and ask any questions. Say what you guys are buying or selling, and let's go ahead and get in. So stocks jumped on Friday, but closed this week with a steep loss. The Dow Jones Industrial Average declined by 3.7%, 3.07%, marking its worst week since March of 2023. So it's been 2 years. This has been the worst week on record, while the S&P 500 lost 2.27%, and the tech benchmark Nasdaq lost a 2.43%, and then 2.47 if you're following that Nasdaq 100. So all of the major indexes are now in the red year to date. The other thing I want to highlight here was that the reason, we kind of talked a little bit about the Dow Jones not quite being in that correction territory, but here we can see that Thursday's market bloodbath saw the S&P 500 join in the Nasdaq as far as in that correction territory. So S&P 500 on Thursday broke below 10.08%, marking it in that correction territory. Now, the reason the Dow Jones stopped from going into correction territory, just falling at 9%, was because it's not as tech heavy, whereas there is still some possibility for it to happen because of tariffs. So, there's still a bunch of investors out there buying the dip, and with the reduced risk of a government shutdown, that just made the markets kind of pop up a bit on Friday. Next article was just here talking about Treasury Secretary Scott on Sunday said that the correction for the S&P 500 and the Nasdaq was a healthy, this is a nice healthy thing we like to see. It's been a while since the market has been in a bit of a correction, so seeing these little 10-15% pullbacks, a lot of investors are happy to be buying at all-time highs. But as soon as the market pulls back 5, 10, 15%, everyone gets worried, starts posting videos that the whole market's going to be collapsing. We're going to go into a recession. No one's euphoric, but this is a really good, healthy sign that, if we continue to move higher, this could be negative. So why it matters, Treasury secretaries don't generally welcome the market falling by 10%, but it's been a while since it's happened. So it's got to just go through a transition with tariffs coming in, government spending declines. There's a lot of changes, and anytime there's any sort of uncertainty, that's when these sort of things take place. There's a little bit of stuff in here. I guess I didn't highlight it through here, but the main thing here that happened last week that kind of affected the Dow Jones more for the negative was that President Trump imposed the steel and aluminum tariff globally, which, retaliations for Canada and Europe with the wine. It also kind of negatively impacted them, which I think I put out a video Friday kind of going over what was the two companies that there was a motorcycle, Harley Davidson, and some wine company that had been hit for around 5-6% on the day. The next highlight here I wanted to kind of talk about was gold. Gold hit an all-time high, breaking above $3,000 as investors and government sought tariff-safe assets. So I thought that was an interesting thing. I don't own any gold. I own some silver, but I have seen silver here in the recent times breaking above $34, $36. So I thought that was very interesting. and there's a possibility of a recession, but it's very unlikely. We know it's affecting the markets right now, and you know all that needs to happen is that uncertainty just needs to come to a resolution, and then it'll recover, right? This is just a temporary setback. So here, all the I can't read. The new gold all-time high came Friday morning, breaking $3,000 just after 4 a.m. So here we can see that if we take a look at the gold prices, take a look at 5 days ago, right here around that early morning time, gold broke and stayed above 3,000 for a bit. You can see right there, 4 a.m. broke above that 4,000 or $3,000 point before coming back down. It's still at 2,993, but you can see this uptrend over the 1 month period here coming out from February 16th is where the market started dipping down. So gold did dip down a bit, but then made a very good recovery here out of those lows for the month of as of February 28th, right? So pretty good. Silver as well. If we take a look at the 1 month performance there, it kind of followed the same trajectory as gold, kind of making that little bottoming out period on Friday 28th before recovering as well. It is up 9.3% from that month low. I'm holding some silver. I'm actually looking to liquidate my physical silver. So I, on Monday, will more than likely be reaching out to a few stores here locally to try and just kind of get rid of that physical stuff. Next article I wanted to cover, highlighted a few things here. What to expect this week. So this article actually did really well as far as what are we expecting in the market this week. One of the big things is Federal Reserve is coming out. There isn't any expected interest rate change. This is something that Jerome Powell kind of noted towards in the past. Yeah, he made some remarks about this in the past, that right now we know what's affecting the market. There's no need to interject and make any adjustments. Here we are with an uncertainty because of tariffs, and that's not any reason to adjust rates just yet unless there's more that affects the market. We also had inflation numbers come in last week that showed lower than expected. Right now, we're looking for retail sales, home builder confidence. That's all being released here this week. So we kind of highlighted a few things here. So Federal Reserve again is to keep interest rates unchanged. The last time that they reduced interest rates was in their final meeting point back in 2024. So they reduced interest rates by 1 whole percentage and then have not touched them here so far in 2025. So 2 meetings now, 2 quarters have gone by where they're just, or 2 meetings at least have gone by where there's no changes to interest rates. There is an expected interest rate, but potentially towards the very end of 2025. And we'll go ahead and see how that plays out. If interest rates begin to break, come back down a bit, say 1/4%, 0.5%, or 1%, that could mean prices being a bit more reasonable, some more movement on the housing. Other things that could affect the housing here. Let's see, this is real estate, not that one. Yeah, the home builder confidence reported on Monday as tariffs on steel and aluminum threaten to raise construction costs. So while housing starts data Tuesday, so we're looking forward to Tuesday for those housing data. We won't see the full effect of the tariffs on steel and aluminum up until the future. How it might affect home builders with their cost. It tends to affect it down the line, say 3 to 6 months. It'll begin affecting them where they'll have a bit of a slowdown there. I think that was all of it that I kind of highlighted within the article. If you guys would like to pause, I don't think there was anything there. There was a little bit of chatter as far as we had Nike, Micron, FedEx coming out with some earnings, but I don't think anybody here in the short term will be affected by, they might discuss some impact that they'll have from tariffs if they long term, which could be negative for them, but long term right now, I don't see negatives impacting them right now. So as from top to bottom, the US stock market has lost around $4 trillion in value as the continuation of tariffs takes effect in the market. So the main thing here I wanted to highlight is that most people can agree that there should be some tension between China and the US as far as tariffs go. But with the Canada, Mexico, and Europe, it's a bit confusing. You know, they're really close allies. You know, Canada and Mexico are just north and south of us. Europe, you know, we have a lot of trades with them as well, generally. So unless this gets resolved over the next month or so, this could actually be some real damage to the economic prospects of the U.S. and all that activity. I don't know what the heck ME stands for. Oh, no, not Mexico, and that's not AA. Okay, so I don't know. So that was the only thing there. You know, they also discussed that Trump administration seems a little more accepting of the idea that they're okay with the market falling, and they're potentially even okay with a recession in order to exact their broader goals. Now, when you're talking recessions and you have recession on the mind, recession doesn't happen, right? When you're expecting a recession, people are talking about recessions. That's not when the recessions happen. Recessions come quick when it's least expected. Right now, we know what's affecting the market. The uncertainty there, we know it's there. So it's just not going to happen. So that, I believe, is some of the main highlights that's going to be affecting the market this week. You know, it could impact it negatively if there's some negative chatter for them. You know, if the market, if they come in here and there's nothing that can happen here. Rates are supposed to remain unchanged. Things that could affect it could potentially be retail showing worries over consumer resilience. So maybe there is some spending decline, showing signs that people are a little bit more wary of spending capital. They're trying to build up savings. A little bit of the home builder stuff that could affect it. And then earnings, as they come out with earnings and they kind of chatter about tariffs affecting them long term, that could also negatively impact the market as well. I would like to see the market trend a bit sideways. I don't want it to recover right away, but I do believe it'll bounce a bit before coming back down. And I think that's it. As far as the end stuff goes, if you guys would like to get $25 of your favorite stock, you can start building over with SoFi. They have an active investment account. You guys can start. You get deposit $25. You get $25. And then also you're able to get up to $325 with making a SoFi Money account. One great thing about the SoFi Money account is you earn up to 3.8% APY. So if you're not using Wealthfront, Ally, or something like that, SoFi is a great one because you can just move money quickly between your checking and savings account. And when it's in that savings, it's getting that nice 3.8%. So that is going to be it. I'd like to thank you guys for watching. Don't forget to go down below, subscribe if you like this video, and give this video a big old thumbs up. Do appreciate you guys, and I'll see you guys in the next video. Bye-bye.